Welcome to RealCrunch software example number 1, a quick flip, modeling a speculative residential home investment using RealCrunch. Here our objective is to show you how easy the software is to model a typical flip type investment. The software opens on the property page, and this is where you put in all the general information and property information regarding the project. Now for this example 1 for the flip, what we're going to do is model a single family residential home. So what we got at the top is we got the general information, and the next item of info to add are the purchase costs, which are the costs that you need to actually acquire the property. And then we have improvements, which are items which will need to be done to the property after we purchase it in order to make it either sellable or livable or rentable. So let's go back up. Go to general information. Let's go ahead and put in a project name. Call it example 1. Location, anywhere to let you remember where it is, author, company, or your name. Issue date. Now the issue date is not issued automatically. The software does not pick a date for you, so you can choose any date you want as the date which the model was finalized, which would be that issue date. So then we come up to the notes, anything you need to remember what the project is, a few descriptors. So let's say 3 bed, 2 bath, residence, fixer upper. Alright, required return, please refer to the website and the support section, and we go over what required return should be and how you configure it. But for this project we want 25% on our contributed equity, not the overall equity of the project. So now I come to purchase costs. Purchase time figures 1 month, which seems fine. Property costs, we edit. This is what we actually pay for the property. Now you can't switch this particular one. Property cost cannot be deleted, and you cannot put the percent of purchase. So, but you can change the name and the item cost. So let's say we found something for $86,500. Notice no currency or comma eliminators. And will lender include this in financing? We're going to assume conventional financing, so you say yes. Broker's fee, we can either delete that or edit it. We'll edit it, and let's say it was a little bit more. You could use a fixed cost too if you want. It's easier just as a percent when you're doing models. Let's say the lender will let that go into financing. So here we go, $86,500 plus the broker fee gives us a subtotal. And let's say we had something else, additional expenses you can add, like home inspection. And that's a fixed cost. Let's say they're going to charge $400 for that report. And no, the lender will not include it in the financing. It's going to be out of our pocket. Okay, and now you can increase the purchase time or make it shorter. What happens is you increase the purchase time, fixed values, except for the property. Property is unique. All other fixed values are going to be evenly distributed across that time. So if you said 2 months, each month will be 200. 1 month is at 400. Alright, now improvements down here we go, is let's go and add something. Let's say paint. Lender won't include it in the financing, so $1250. And let's add general landscaping. Nope, lender won't include it, so $2,500, $22,500. Again, notice no currency or commas. We add that, and here's our subtotal for all of our improvements, and then it's added for the total project costs. And next, we'll move on to cash flow. The cash flow page is where you enter all the information regarding any income and also the sales revenue. So looking up at the top here, we have to change, if you're doing a flip, is the holding period, because the income and expenses are really set up for income property, so we're going to set that to 0, because we're not holding the property for any income period. So then come down here, property sales, where we're going to enter all the data for the flip. So let's assume, based on our research, we can sell this property. Let's just say $120,000. Notice no currency or comma eliminators. Sale time, let's say 3 months. Alrighty, let's get the broker's fee. Say we research that, ends up being 5%, so we can edit that. So it's updated, and we want to add that we're doing some advertising. Now, similar to the fixed cost that you saw in the purchase, we do $500 a month for 3 months. It's going to take this total value and divide it evenly among the time frames. So 1,500 divided by 3 is 500 a month. If you increase the time and you want the same amount of advertising per month, you'd have to increase that value. So So here we go. Here's our revenue is from the sale. We're going to sell it for 120. Our costs, we're going to have 7,500 in costs contributed to that sale, and then here's our total revenue. So next we're going to go to the finance page to see how we're going to pay for this. Now the finance page goes over all the project financing. See, we have the general information up at the top, primary lender, which is going to be our first mortgage lender. Then we have equity investors. Now equity can be second mortgages, third mortgage, lines of credit cards, HELOCs, and investors obviously can be the investor or partner. Alright, so let's look up at the top, project financing, general info. We have the total project cost, which is the all-in for the purchase, and then the financeable project cost, which you notice is much less because this deducts all the items that the bank will not consider when they value the home for financing. So let's go down here, primary debt lender, loan to value, let's keep it 80% amortization, let's present someone at 20 years. Interest rate's 4%. Then here is the closing cost. Now when you put in the closing cost, make sure if the bank includes your broker's fees that you don't add them twice, so you're not penalized twice. Alright, so we pretty much use our first mortgage, 80% loan to value, debt service coverage, we keep it at once, not applicable, that's for income property. Interest rate's 4%. Maximum loan amount the bank is willing to give us is $72,660 minus the closing costs, so we only get $70,000 actually going to the project, and that leaves us with the required equity out of pocket, or with our equity structure is we need to find a way to finance an additional $24,800. So let's just go ahead and let's say we found an equity loan, and say Fast Eddie loans, and let's pretend we get 15 grand. Fees unreasonable. Yeah, let's say it's a more amortized 14% over 20 years, so $188. So there we go. Now it's important the order that you put in. The order you put the loans in is the order they get paid, because our distribution is a waterfall distribution. And just for the example, let's go ahead and add a credit card. Card amount, say we can get $5,000. No fees because say it's a credit line. Annual interest rate. 18% minimum balance. Here you got to look into your credit notes or your credit card summary statements. They'll tell you what it is, either 2 or 3%. Let's say 3%, and yeah, that's more than the other one. But here we go. That's a credit card for you. Okay, so now we got our two equity and lines of credit up here, and it seems that we still need $7,000 to go. So the contribution of these two, 17 grand. There's required equity. Remaining equity is what's out of your pocket, so we need another 7 grand. So let's add an investor. Let's call them an investor 1. And let's see if we can get them to cough up 5 grand. And we don't have any revenue because we're a flip, so leave that blank. Profit sharing. We could do % of the profits, but put in 5 grand. We probably want to pay him back, so give him 7,500. And minimum return on investment. You can put a number in here, but honestly, for such a short project timeline, and little amounts better just to keep it fixed. If you're doing long income properties, then you'd want to put a minimum in there just to balance things out. So we add him, and there we go. Now it looks like our contribution on the front side for these costs, not including the actual operating expenses that you'll see later, is we got to put up $2,315. Alright, so next we'll go on to the pro forma, and then we'll check the return. Alright, on the pro forma page you'll see all the expenses and income items. Everything is placed where it's supposed to be. Right now we have our time period in months, and you can switch that to years, but we're such a short project, what happens is you'll get an asterisk next to the period, which means this is a fraction of a year. It's not a full year. So, smaller timeline's better, just keep it in months. So here we go, months. Here's our purchase items, which occur in the first month. Improvements are in the second month, because you don't want to improve anything till you buy it, because you don't know if you get to keep it or not. And then property sale. Remember, we have 3 months of sales, so here's the 3 months of time. The $500 for the advertising is distributed amongst those months. Here's the fees and everything. Here's the cash flow from the loan. First we get the money. This is the money that goes towards the project, not the entire amount. Some of it goes to fees. Here's the loan payment, and then at the end the loan payoff plus a month payment. And here's the cash flow we're left at. This is all the cash after all the items are paid and whatnot. Then at the bottom we have the project returns based upon the overall project, basically this line here. So overall we use the same required return as we did for your required return you put in the beginning. It's also known as the opportunity cost of capital. And it's showing a positive net present value, which means that the returns that we see here do exceed our threshold requirement, so we're good to go. Then the internal rate of return, it's set yearly, and also the OCC is yearly, so they're adjusted to meet on a monthly basis. Alright, so looking good. Now let's go to the next, let's go look at the returns, the new button that popped up, and see if we made any money. Finally, we're on the return page, and this is the page that tells us finally how we did in the project and how much money goes in our pocket. So, looking at the page, you'll see at the top you have the equity return table, which basically lays out a time frame of equity payments and cash flows, and then we come down here and we'll have the investor return summary for each investor. So coming back to the equity return table, we see we have two choices. You can show it in months or years, and again, if you collect the years, it's going to collapse into a one-year cell and give you an asterisk saying that, hey, this is not a full year, or less than. So let's go back to months. Cash flow comes directly from the pro forma, and then we have the equity loans first, and then it lists each loan, the contribution that comes after their fees, and then the monthly payments, and then the payoff, including the monthly payment. And same with the credit card. Then the remaining cash is the balance left over after we make these payments. And since this is a flip and we have no income, these items only increase. So before, with the cash flow, we owed $945 off the first lender. After we have to pay the other equity lines of credit and loans, we're actually up to $1359. So then we come down to the investors, and again they're listed in the order they're given. Investor due, which is this is our line, so they owe us $5,000 because that's what they said they're going to contribute on the first month, and then we got to pay them $7,500 at the end. So this is the line due, which is us, our contribution to them, and paid. This is pretty much their line of cash flow. So he's out $5,000 and he's going to get back $7,500. And that becomes important later if you look at income housing. All right, remaining equity. The equity return, this is what we get. So notice that we're actually up. So first month we're making money. That's because the contribution of the investors are actually supposed to go to a lot of the landscaping and painting. So this money would be reused over here. So he actually didn't make any money. Just this money would be reapplied later. And then here you are stuck with the $1359 each month, and then at the end we should make, looks like $14.9 of profit. So then we can come down here, look at the investor return summary, and here it says investor one paid. You see they put in $5,000, they got back $7,500, $2,500 profit in 5 months, not bad. And the yearly IRR is 237.5. But in order to actually get a yearly return, you'd actually have to have projects all year generating the same return to realize that. But this is just a measure. It's a good measure of seeing how the project's doing. Such short time frames, they get up pretty high. So equity return, how do we do? Well, we thought we were only putting in $2,000, but we end up having to come up with $7,000, and we got back $16,000 at the end of the day for a profit of $9,000, which is still that's pretty good for 5 months. So it's still a pretty good project. So if the numbers looked real and whatnot, would you want to consider looking at further? And then after this, you go to do some stress tests, changing time frames and different assumptions to see, how the project will perform under certain duress and risk and whatever other type of stress test you want to run. So that should be it. That's all you got to do. Pretty simple. So I hope you like the software, and take a look at the other videos to see if anything else you want to do.